Hi class. So I am going to work through exercise 2-1A and 2-2A in preparation for you to work through 2-3A in Connect. Okay? So what we're trying to achieve in this problem is that they gave us several pieces of information. We're moving into sometimes when we do work for people, they pay us later. We bill them and they pay us later. So that means the cash comes in a different period than we earn the money. But we still need to record that we earned the money in the period we actually earned it. So we're going to book what they owe us into accounts receivable so that we can get it recorded in the proper period. So what you learn as you get more involved in business is that the cash lags when we actually do the work or when we purchase things. Often for our business, we purchase things like if we're a manufacturer or we're a retailer, we are getting things from suppliers and they bill us and we pay them later. When we need to pay a supplier later, we call that accounts payable. Or some of you may have had a job where you got paid weekly or every 2 weeks, but remember, and you filled out a time card or you clocked in on a time clock. The problem is they can't pay you the very last day of the pay period because they need to work up how much they owe you, unless you're on salary. If you're on salary, everybody is always getting paid the same amount regardless of your work. But if you're hourly, there's always a lag. So let's say it's the last week of the month, so they record what they're going to owe you because they don't pay you for a week or two later. So a lot of us have lived through that in our jobs. So you get how you can see how the cash does not match up with when we really earned revenue or when we really incurred expenses. We need to record when we actually incur expenses or actually earn revenue in the month that it really happened. So that's what we're trying to achieve with this Chapter 2 work. So I'm looking at 2-1A. Holloway Company earned $18,000 of service revenue on account during year 1. The company collected $14,000 cash from accounts receivable during year 1. So based on the information alone, determine the following for Holloway Company. So we're going to record the events in the general ledger under an accounting equation before we answer the questions. Okay? So I'm going to do my usual assets equal liabilities plus stockholder equity, and I'm going to have cash and accounts receivable here. Under stockholder equity, I know I'm for sure going to have common stock and retained earnings. Okay? So if I if I did the work of $18,000 on account during year 1, when they say the words on account, okay, that means we did the work and we billed people. So we're up on accounts receivable $18,000 and we're up on revenue $18,000. Okay? Then if it says that we collected $14,000 from our customers, that's called collections, and that means the cash increased $14,000 and it reduced what people owed us by $14,000. Okay? So to answer question 1, the balance of accounts receivable at the end of the year would be that people still owe us $4,000. Okay? Now, part B says the amount of net income that would be reported on year 1. Well, everything we earned would be reported. So $18,000. is the retained earnings, or is the revenue that we would record during the year, that would show on the end of the year statement. The amount of net cash flow from operating activities that would be reported on the year one statement of cash flows. Okay, well, that would be the $14,000 that we took in from our customers would be operating cash flow. So there's the answer to C. Here's the answer to A. Here's the answer to B. Okay. D, the amount of retained earnings that would be reported on the year one balance sheet. Well, they didn't tell us about any expenses that we incurred, so apparently we didn't have any expenses. So this would also be the answer to D. Retained earnings is $18,000 at the end of the year. And E, why are the answers to requirements B and C different? Because, like we said, cash flow lags, and it sometimes happens in a different period. So here's what happened. We earned $18,000 in revenue. We collected $14,000. So $4,000 of it is going to come in the next period. We'll collect it in the next period. So our cash flow from our normal operations was only $14,000, even though we earned $18,000 in revenue. Okay, that's it for that problem.